I am so happy that you guys are here. I am so looking forward to Miss Emily sharing with us all about 1031s. So I'm just going to hand it over to Emily, and Emily, you can do what you wish with the next 50 minutes or so.
Okay, I won't put everyone to sleep for 50 minutes, but so my name is Emily Robinson. I am the owner of Rally Point Title and 1031. We do mostly title insurance, and our home state is New Jersey. We do PA, Florida, and New York as well, and then 1031 exchange, acting as the qualified intermediary, and that's really national. The 1031, as we'll go through. Is is a federal stipulation, so that can really be done in any state. We see that a lot cross state lines and things like that. But my goal today is really just to spend the next few minutes diving into like a very basic level of the 1031s. We get a lot of people that ask, I guess, on the selling side or the listing agent, things like that. A lot of times we get the clients who are kind of a little gray in it, like they've heard about it, but they don't really know where to start or what the process looks like. And when you're dealing with, I guess, some of your investors yourselves, but also when you're dealing with a client that's the sellers, like all they know is that they want to sell their property, right? Like sometimes they lean on whoever they're working with for either to act as the resource for those questions or to find or maybe they work with one and stuff. And I feel like that's where we come in as like a partner. A lot of our partners are referral partners who they may not know the answer, but they can reach out to us fairly quickly and get through these things. So I'm gonna let's see, I guess I'll share my screen. I think I can do that. Um, Screen two. Share. Sorry, I talk to myself every time I do this. And I think I can present it right here. So can you guys see that? Yes? Okay. Um, so basics of the 1031, and I have a little bit of an outline of key points to discuss, which would be what is it, benefits. I think everybody probably knows the main benefit, which is deferring the tax. Key terms to know that some vocabulary you're going to hear throughout the process. Purpose, identification rules. Number five, the ID rules, I think is like the biggest hang up for the 1031. I always tell people like it's great that the government has given us a way to defer these taxes, but they by no means make it easy. You really do have to follow the rules, and there's really no exception. You know, you either do or you don't. And sometimes I think there are definitely deals where things fall through, or people are like, well, what if this happens, or what if my contract falls through, and this and that. It's like, well, then you should have planned better. There's really very little exceptions to some of the rules. And then at the end, I'll just go over some contact information and maybe like a timeline of the process so that you kind of know when we come into the picture. Um, so let's see if I okay. So we'll talk about what it is in just a very surface level definition really it refers to the Internal Revenue Code. So like the IRS code is code 1031. That's why they call it that. And you can defer the capital gains of real property. Not necessarily not paying the tax. This is by no means a way to get out of it. There are different, as you get into like the layers of the 1031s, I know people do use this as maybe like an estate planning strategy and stuff where you would really kind of explore with your accountant ways to maybe just continue deferring as an estate plan. But really, most investors are just deferring, changing maybe markets from retail to commercial, or just taking an investment and getting something bigger, more income, things like that. So, but it really only applies to real property. So, that's important to know. Some people think they can do it with like maybe a restaurant or a business, but it really is only attached to the property. And it has to be for income producing or investment purposes. So, you can kind of define that in a very broad way by saying, you could have investment property that doesn't necessarily you make great income off of it. I've had people ask me if it has to be income producing. Um, yes and no, right? It can't be your primary, but no one's to say maybe you're a bad investor and you don't make money on it. Like it can really be either way. But the biggest thing to know there, it cannot be your primary residence. And the point, like I said, is to not recognize a gain or a loss. You want to just keep deferring it. Really, like I said, kicking the can down the road for those capital gains. And it can be very significant if you've I always tell people too, like our role is a qualified intermediary. We're not going to be able to tell you how much tax liability you might have in a certain property. That's really where you need to determine if it's worth it for you to, just sell it like you regularly would, or to do the 1031. And an accountant really, if you don't have an accountant, you should have one. Obviously, I'm sure a lot of people here have tax professionals to rely on, but they would be able to break down to the dollar amount what you would be liable for. And then that's really a lot of times where people will make that decision. So we'll talk about the purposes, benefits, purposes, so it's reducing the capital gains tax at the moment, right? So like I said, you're deferring it. You can leverage the investment. So if you have a property that is, um, worth $300,000 or you want to exchange it into something bigger and, you're going to be able to reinvest the money. That's the point, is you can reinvest that money that you sold it for, put it in a new property. Now you can, uh, grow the income, right? So if you're making $1,000 a month, maybe you 1031 it into another property that you're going to make $3,000 a month. So that's really, I think, why most people are doing this. They're able to leverage the investment, produce more income. Um, Diversification, I think, is a big one too, especially now as we see people might be, you might be in a residential property, want to switch it to commercial or retail. Like it doesn't have to be residential for residential or commercial for commercial or retail for retail, things like that. You can definitely cross into other markets. And we see this a lot in New Jersey. And I know not everybody here is in the same area, but at least in New Jersey, the Northeast, New York, really high taxes, not really number one on landlord friendly states. So you see a lot of people who might want to take that property, sell it, and maybe get tenants or another property in another state. Florida, Georgia, the Carolinas, like maybe something they could maybe sometimes get more. Like you get a 3 unit in Georgia for selling one property here, things like that. So you see people diversifying that way to reinvest their money in other markets. And I think one of the biggest questions we do get is like if they can go to another state, it's always yes. One thing to keep in mind when you cross state lines, though, also is the taxes that might apply on that particular state just for the sale. And I mean that in the sense that, like, even if you do a 1031, like I know in the state of New Jersey, if you have an investment property and you sell, uh, actually, let's say you're not a New Jersey resident and you sell it, you still have non-resident tax. So you still have transfer tax, non-resident tax, that you're not really deferring those things, you're really only deferring the capital gains. So, and this is really just more on that, deferring, avoiding it, upgrading, consolidating. So you could sell one property, buy two, sell two properties, buy one. So you can kind of go from, you could sell five properties and buy one. You can do the 1031 into various different strategies. There's really a lot of things that you can do. And I think there is a misconception there. It has to be because one of the definitions says like kind, but it's not like kind in the type of investment property. It's just like kind that it has to be investment to investment. So, relocation to a new area, I think that's a really popular thing that's happening around here because the market is so tight and sometimes people can't find something here, or maybe the price point doesn't make sense. North to south makes a lot of sense for people as far as prices go and taxes. So, and differences in the areas, right? If you have other up and coming areas across the state, let's say go to Texas or Tennessee or somewhere else, there's just so much strategizing that I think goes into like where people 1031 that it's just very broad. It can go to, like I said, retail, commercial, industrial, whatever they want to do. Um, let's talk about the things you're going to hear, right? So you have the relinquished property is your property being sold. Replacement property is what you're going to replace it with, what they're buying. Okay, those are the two things that your 1031 or QI company is probably always going to refer to, the relinquished and the replacement. Boot is what they call the cash that goes to the seller. So you don't necessarily have to 1031 the entire sale proceeds. You can do a partial exchange. It's just keeping in mind that if you sell something for 500,000 and you only want to 1031 to 250, obviously you can do that. But the remainder that goes to the seller is now triggering the tax. So they say, I think a lot of things online say like, oh, well, you have to defer 100%. It's like you have to defer 100% or buy something of equal or greater value to defer 100%, right? You don't necessarily have to. You just have to know that you're not deferring the other capital gains. They're going to have to pay that. Um, and the qualified intermediary part is really, and that's really where our company would come in. Like that's the role that we play. But one of the biggest rules is that you cannot, as a seller, be in control of the money. You cannot receive the proceeds. Um, they call it a constructive receipt, which can mean a lot of different things to different people. It depends on um, it's a little bit of a broad definition of constructive receipt because it means that the seller doesn't have access to the funds and don't have the ability to use the funds. Um, and so the money really has to go from closing from the escrow company to the QI and then to the sale. If at any point in between it goes to the seller, they're just immediately disqualified. So that's always very important. And the qualified intermediary has to be a neutral third party. It cannot be their attorney, their accountant, their brother. It has to really be someone pretty removed from either side of the transaction. So the requirements are, like I said, this is one of the biggest things is you can defer the tax, but they do not make it easy. So you have the 45-day identification rule, which I do believe is probably the hardest part. You have to identify another property within 45 days. And we get people who, don't start. I always tell people, please don't start looking when you sell the property. Like if you know you're going to do a 1031, you've got to kind of get that ball rolling. Like, it's, it always seems like a lengthy conversation to have with people, like, and we're just kind of beating them over the head, like prepare, 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 like plan, 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 like know what you need to do because when you sell, the clock starts. Clock starts day one when you sell. Now you have 45 days. If you didn't even start looking, it's very hard to identify property in 45 days and have it go through. Like you could probably identify one or three or whatever. But what if that one falls through? Like what if on day 42 you have an inspection and you're like, I don't want this. It's kind of over. You really don't have a second chance. So I try to tell people to go ahead and start shopping before they close. You want to be strategic in lining up your closing dates. It doesn't have to be perfect or the same day, but it should be close. Like you should have a really good idea. So if you have clients that are doing this, that's probably a really good thing to tell them ahead of time is to like really try and get ahead of it. Um, After the 45 days, the 45 is included in the 180, but you have 180 days to close. You have 6 months to close. That's achievable. In most cases, you can close on a house within 6 months. I think that's fair. The hard part is identifying it, and it has to be in writing. For us, we have a very specific form that says, after you close, this is what you need to fill out. They put the property they want, or they a lot of times they list about three. Um, that's fairly straightforward. I think it just requires it's a lot of like follow up, getting people to actually do it, submit the form because it's a big deal when they don't. Right now it's tax season, so I have people are reaching out for copies of their forms because they may have signed it, didn't keep it. They're like, I got to do my taxes. Um, so I think the planning part is just such a big piece of a 1031. I can never really stress that enough. Um, a lot of people do like the I guess it's the three property rule where they can list three, buy one. You can also they can list as many as they want as long as the fair market value doesn't go over 200% of the relinquished property. So like there are other rules. I think majority people are identifying up to three, regardless of the value. And that's probably the most common thing we see. Um, I think common mistakes I'll go through kind of quickly is failing to research, not understanding the timelines. And these are questions they can obviously ask, like their agent, attorney, if they have a QI, ask them. But there's definitely situations where maybe 2, 3 days before closing, and the seller's like, well, maybe I should do a 1031. Like, is there still time? And there usually is, but it just gets it gets a little muddy when it's that tight, Not using a QI. That's important because when the IRS does ask for these documents, you want to be able to like line those things up like you should. You really don't want it to be kind of open to scrutiny or an audit. So, using a QI is very important. Mixing business and personal. There are ways that if you have a investment property and maybe people use it part-time or maybe they go there for like, you know, 2 weeks every year or so, there are prorations for that. And that's really on the accounting side. Like you have to tell your accountant that like this is an investment property, but I go to Florida for 3 weeks in a year and I use it. Then they kind of prorate, and they can work into like what should be deferrable or what wouldn't. So I think we even had one recently where they had lived there for a while, and then turned it into an investment property. Like obviously you can still 1031 that. There's usually just a timeline period that you have to wait. I think it's like a year or something. But anyway, things like that, like mixing the business and personal. If you have a property that you kind of like people kind of use for both, it's really questions that I direct to the accountant because what I can say from being the QI is that I think some people confuse us as also accounting experts. And I'll go into what our role really is, but working with a good accountant is going to kind of really make or break, I think, the 1031 when tax day comes and they got to file things and ask questions. It's pretty important. Self-managing instead of hiring, that's kind of an easy one, is just getting ahead of it uh, pretty early and having the people in place pretty early, I think is important. So what do we do, right? Like as a qualified intermediary, like our job is to prepare documents for the exchange, but really it's holding the funds. So like we're hired to hold the funds in a completely separate segregated account, and that's an important thing too. If you have a title company, even that is doing 1031s or a QI or attorney or an attorney, whoever is doing it. Um, oh geez, they have to make sure that the funds are completely separate. So like a title, like an escrow company, we have an escrow fund that has 100 closings in it. All the money is commingled. Like they cannot be commingled funds at all. It has to be just very specific to that transaction. So for every 1031 that we have to open up a sub account. It has to be completely separate. Like that has to be very clear. The client would get like copies of their statements, and they're usually dual authority accounts where we can't release funds without the signature or authority of the exchanger anyway. So those are just kind of some things that really have to be in place. And for someone who's shopping for a QI or calling around, like those are questions to ask. Like, how is the money protected? Where is it kept? Like, do I get account information and bank statements? Like, how do you even know where the money is? And confirmation that it's separate. Confirmation that it's separate, I think, is very important. But our job is to hold the money securely and facilitate the exchange of the money from sale to purchase. And how do we do that? One is obviously getting ahead of their sale. If they know they're closing, we need to know who the people are that we have to be in touch with so that that title company doesn't accidentally mail a check to the seller or send it to the wrong person because that would disqualify them. Other than that, it's, exchange documents, things they have to sign, a W-9, the basic stuff. We ask for a copy of the deed, the title report, things like that, which are pretty straightforward. But at the end of the day, the QI is hired to facilitate the transfer of funds. Okay. And I guess I kind of talked about that already, but neutral third party to hold the exchange proceeds, delivery of funds to the seller of the replacement property. So holding it from the seller, then giving it to the buyer. Those are all things we coordinate. If you're in a state that uses an attorney, then your client can be pretty hands off with that. A lot of times we're dealing with the attorney, so they may not feel as sort of weeded by all of the correspondence and stuff. If you're not in an attorney state, it's probably mostly going through the agent back and forth with the escrow company. So a lot of times the client themselves really only see maybe us in the very beginning and the end, maybe like after it closes and things like that. As far as cost, like for us, it's a flat fee. It's 1450, but I think any QI is going to be between 1200 and 2000, maybe depending on where you are. Fees can increase depending on what the client wants. Like if we rarely go to closings, if we had to or send a notary for any reason, there'd be charges for that. But across the board, it's a flat 1450 to hold and release. But I would expect up to 2000 depending on where you are. Like if the further north you go, the more it's going to cost. Um, Common questions are like interest rates, purchase and selling multiple properties, how funds are protected, the type of accounts. And I kind of went over some of that where it's a segregated account. There's like fidelity and surety bonds and insurances in place for the money that we're holding, right? Of course, like any title company would have probably the same thing. Um, Purchase and selling multiple properties. And I kind of went through this list backwards, actually, in the interest rate. And interest rate is important to ask because the client can collect interest on the money that is held with the QI. Our interest rate right now is at 2%. So, if they're holding $500,000 for 6 months, right? Like they're at least going to make something. They're not going to make nothing. It's not substantial, and of course, it's taxable. That doesn't really count towards what you're deferring, but they can at least collect a little bit while it's being held. Um, Allowable costs, like anything that's not a closing statement, is going to be part of what they probably wrote off during this process, right? So they can like exchange fees, broker commissions, title escrow, all that's coming out of the 1031 exchange funds. Like when they buy, that can all be applied to those things. It's not necessarily something they have to pay separate. Um, Anything that's a normal closing cost, really. So I'll go through real quick just like what the steps would be, right? So if you have someone who's looking to do a 1031, they're gonna, are they eligible, right? Is it investment or personal property? Or I'm sorry, their primary residence. Coordinating early with who their agent is, their QI, things like that. Deciding on the type of exchange, I think really comes down to them having that discussion with their tax professional on what their liability would be, because they're going to, the best way for them to get some kind of feel of if this is even worth it for them is going to be that question. Like, what do I even have to pay if I just sell it? So, um, contacts and resources. I always say that that's probably really number one because you want them to get ahead of it. What happens, where we start really is I like to start at least like a week or two before closing, like a heads up on that kind of timeline of their sale is a good timeline for us to get an exchange agreement prepared, get whatever they need signed, because some people want to print it and sign it, and some people want a docu-sign. Like everybody's different. So getting the exchange agreement, which is an agreement from us to the exchanger, is really step number one. They sign that agreement, they send it back to us, hopefully a week or two before closing. And then we're going to prepare, we're going to open up a sub account, get in touch with their escrow company, determine where the money is, and make sure they know it has to come to us. Things like that we're going to put in place after we get that exchange agreement. That's why I say 1 to 2 weeks before closing is a good time for a good amount of time for us to get those pieces in place. They have to send us their sale contract. We send all the people that need to know who we are. We send them our confirmation. Um, Scheduling closing day. Like these are all things that we're tracking inside, like in internally. Closing on the sale, dispersing the funds. So once closing day is scheduled, we can kind of track that from there. Closing on the sale and getting the money to us. That's really when it starts. That's when the clock starts for their whole thing. Oh, did I go the wrong way? Where am I going? This way. Okay. So after they close, they have the 45 days to identify the property. Like I said, that's probably one of the hardest rules, but we'll follow up with them like 2 or 3 times in the interim. If they haven't really responded to us or told us what property they want, we keep sending that form to try and get it from them. Like I said, if they go past 45 days, it's considered a terminated 1031, and we send the money back to them. So at that point, we just send them a draw request form, wire requests, things like that, and it's kind of over at that point. So try to get that ID form pretty early. Once they get under contract, it's the same thing, sort of maybe opposite. We're just going to get in touch with their parties, make sure they know that the money's going to come from us, things like that. Scheduling close a day and closing on the purchase. Once we close on the purchase, it's pretty much over. So from there, oh, yeah. So from there, it's pretty much done. So, like, once they close on the purchase, other than like releasing some other monies that would be like maybe the interest they accrued or some other kind of overage they might have, It's really just giving them a packet of their documents. And then, like I said, sometimes they come back around this time of year, they resurface and ask for documents for their taxes. But other than that, it's pretty straightforward. But like I said, I think the biggest thing for people is getting ahead of identifying property, knowing like the kind of market they're in and what they're looking for, things like that. And I didn't really make a slide for this, but we see it a lot lately is people who don't want to really necessarily be a landlord anymore and they're looking to sell the property, do a 1031, but they don't really want to buy anything, or maybe they don't know what they want to buy, is doing the Delaware Statutory Trust Funds. I don't know if anybody here has heard of that, but it's just a way that investors can still do a 1031 and they can actually put money into a fund that's like a shared, like shared with multiple owners, like let's say hospitals, industrial buildings, things like that. And it's a very passive way to kind of plant the funds, defer the taxes, and still collect a monthly income. Um, and that's something that I think we see a little bit more of, I think, in this area as of late. And I think it's very telling of the market because there's the people that can't find stuff or the numbers just aren't making sense for them, that they're like, you know what, I'm kind of done with it. I'm just going to put my money here and collect a check. And there are pros and cons to that, but there's so many different options you can do that strategizing ahead of time I think is key. Um, but that's really it. So my name's Emily. We're Rally Point title and 1031, and if I can help anybody or answer questions, happy to do so. But thank you.
So, Emily, real quick, what we're going to do is we have questions in the chat, so we're going to do those first in the order of which they came in, and then we can open it up to the whole floor
Okay.
if that works. So, Julie was the first one to ask a question. Some of the questions you probably answered already without even knowing it, but Julie, do you want to ask that question that you put in the chat?
Oh, sure. Thank you. I appreciate your information. It's invaluable. Does the selling entity of the property and the purchasing entity have to be the same? Or in the event that you have layered or stacked entities, can the top controlling entity be the one that's the same?
So it has to be the same taxpayer. So
Okay, so it's by
So
tax
yes,
ID.
the answer is yes, I guess. Like the tax ID has to be the same. Um, and there are situations I think that I've seen people like they know about that ahead of time. They might make deed transfers and change names on things before they get into selling and things like that. So, but yes, the taxpayer does have to be the same. Yeah.
Thank you.
Okay, great. Sean Hanson, because we usually have a few Sean's on. Sean, do you want to ask the question, or would you like me to ask it for you? I don't know if you can hop on. Okay, so I'll ask for you. Uh, also also with the sale of one property, can you only buy up to three?
Oh no, you can buy as many you want. You would use that other rule, the 200% rule, where you can list as many as you want as long as it's not more than 200% of your relinquished value or fair market value. So you can buy more. It just can't be, you can't identify more than the 200%.
Awesome. Okay, and then Carrie, you had a question or two, I think.
So, can you do it like can you buy a property first and then do it as like a delayed transaction, delayed finance
Yeah,
with
so you can
proceeds?
do a reverse exchange. We particularly don't do reverse exchanges because you need a tax attorney. So a lot of times, if you have a good accountant, they'll refer a tax attorney. Um, it gets it definitely is a more complex transaction because you cannot hold title to both properties at the same time. So if you're doing a reverse and you want to buy first, usually there's a tax attorney in the middle that prepares a deed and holds the property for them until they're ready to sell. So being that you can't hold both, you basically are hiring somebody in the middle to prepare a deed, temporarily hold it, and then you go under contract with that person. And when you sell, it becomes yours through all of that. But the price point is something to note too. It has to be worth it for people. It could cost like $12,000 to do something like that versus like a flat exchange or forward exchange is like a flat fee. It's a couple $1,000s. Once you get the that deed preparation involved, it's a little bit more, so if someone's selling a big, if it's a big capital gain, it's totally worth it for them. But um, it can be done, yes, just different
Okay, one
process.
more question. So I know someone out here, and I got obviously when they told me that they did this, I was surprised that this was allowed. So they bought a property using a 1031 as an investment property. They rented it out for 3 years because they were told that 3 years was how long it had to stay an investment property, and then they moved into it as their primary after that. Can you do that?
They can. There's like a holding period, or a phase like he said of holding it as investment to qualify for the 1031, and then they can change it. They can,
Oh,
yeah,
okay. Wow.
yeah.
Good to
And
know.
that's really like the I don't know if I guess when he converted, I mean, however they did their taxes, I mean, there might have been some kind of proration for that, but I do believe you can do that, yeah.
Okay, cool. Thank you.
Paul is the only male in this group right now, and it's only because I know him. So he messaged me last night and asked if he could. He messaged me respectfully and asked me if he could show up because he's in the process of possibly doing a couple. So of course I couldn't say no because I don't. So if you see Paul in the group, this is why. Paul, you have some questions you want to ask, Erin?
Yeah, thank you, Kim. Thank you, ladies, for having me. Yeah, I am in the middle of doing two 1031 tax exchanges. I have sold two long-term rental properties, closed on them this week, and so now I'm in that 45-day window to identify properties to buy. My question, Emily, regards, well, first of all, can you change your list? I know you can submit up to three properties per exchange. But during that 45 days, if you happen to see another property that you like better or something on the that you
Oh
already
yeah,
have,
you could
can
change that.
you change
Yeah,
that list up?
yeah. You
Okay.
can change it. I think it's there's nothing more can happen after 45 days. But if you change it within that window, that's not an issue. No.
Okay. And as far as documentation goes, what documentation should you ask from your qualified intermediary that you're going to need to give to your accountant so they know that this was a rightfully done exchange, and they can recalculate your depreciation schedule on the new property?
So you want and this is stuff you'll get along the way anyway, but it's you want the copy of the settlement statements for both. So you want the settlement statement from your sale, the settlement statement for your buy, both contracts, copies of the contract for each, and then that identification form and usually the wire confirmations. So there's like maybe five or six things that you're probably getting it along the way. But those are definitely things you need to keep is the settlement statement, the ID form, the wire confirmations going in and out. And then I always give people the bank statements anyway to their account. So they don't always ask me for the wire confirmation. The bank statement is sometimes enough if you get that. Um,
I
and
got
that's
an
really it.
email. I'm sorry. In regards to I did get an email with the confirmation that they had received the wire for X amount of funds for each property. So that would be the confirmation of the wire, or would I need something else?
Like someone saying they received it.
Correct.
I mean, usually there's usually some kind of attachment that shows the incoming and outgoing wire with like the
Okay.
dollars, the account numbers, like incoming and outgoing. Them receiving it is probably fine. Maybe I just overkill people with documents, but um, all of that stuff is going to be important if you get audited. So I always tell people just to have it.
Okay. So she did send me some attachments too. I'll just have to double check those. That may be the
Yeah.
thing. The last thing you mentioned, the Delaware Statutory Trust Fund. Um, could you, would any syndication, I mean, if you're doing an exchange, could you exchange into any type of syndication, or does it have to be Delaware
It doesn't
statutory?
have to be. I think that's just what we see the most of.
Okay.
But technically, you can if that would probably be a good accounting question to make sure that whatever fund or um, partnership you're going into, because you can hold title together with other people or other entities or something like that. But the um, the Delaware Statutory Trust, I think we just see the most of. I don't necessarily think it's the only kind of fund you can put the money in, but it definitely has to be something that's buying real property. I think that's the biggest
If
thing. Yeah.
if they use that to buy commercial property and then they sold that property and paid you back as the investor for your part that you invested,
Mhm.
at that point, I guess you would be required to exchange that into something else
Mhm.
or
Yeah,
pay the tax consequences?
exactly. Yeah. Even if you were part owner of something or whole owner of something, if they give you back the money, right, you're paying capital gains then, or you 1031 it again. I know with some of those funds, there's also a holding period where the money's not really, um, not necessarily liquid, but you can't like have it for, there's penalties to do something like that and then sell it or do another 1031, let's say within 3 months. Like if someone can't, because I've had this question before, like, well, if I can't identify in 45 days, I'll just do this fund as almost like a placeholder. And you can't really do that without probably, I think, significant penalties to the money. And I think that's a 2 year holding period. So some people, they either, that's why I say I think a lot of that movement we see is people who don't really have interest in maybe buying something else soon, or they don't have interest in being a landlord and they're just going to plant their money there. But the holding period is much longer, obviously, than holding a regular property that you have control over. So, yeah.
Okay, thank you.
Thank you, Paul. Sean had another question. She said fix and flips, they do not qualify, right? As considered a part
No,
of the property. I
yeah,
thought
you
so.
have to hold it.
Okay, great. And then let's see, we're gonna go down the list. Paul, she answered your questions. Thank you, Emily, for doing this. I appreciate it. Karen, can you hop on and ask your question?
Oh, the 4 unit question?
Yes. Was it answered? Yep,
No,
pretty
I
much.
don't know. I don't know. I don't know. But if you have multi-units and you live in one, those are just prorated
Mm,
tax liabilities. So that's what I mean by like asking the account what your liability is. Because if you live in a unit, that's your primary, and you have three others are investment properties, even if it's partial, um, there's a percentage or proration there that can happen.
okay, got it. Awesome. Okay. D asks, can the 1031 money be used as a down payment on another property?
Yeah, you can take an advance from it as a deposit for your replacement property, if that's what you mean. Yeah.
Okay. D, you want to hop on? Because I see you had another question in there.
Yes. So with that first question, can all of that money be used as a down payment on another property or just a portion of it?
So the money, whether it's all of it or I mean most down, oh, you mean down payments like I'm thinking deposit. You mean like down payment like on closing day kind of thing?
Right,
Okay,
right.
so
So
like
if
your cash to close?
exactly.
Okay, then yeah, and that's what it's gonna do. I mean, you could exchange a $300,000 house and buy a $600,000 house. All that money's gonna go towards your purchase, which in my head is like kind of like your bottom line, whatever is due on closing day, and then maybe that you can mortgage the rest or whatever. But um, yeah, you can still defer all of that. The only time I guess that's not going to apply is if you bought a property that was worth less or a lower price point than what you sold for. You're gonna have an overage, and that would go back to you.
Then you would have to pay
Yeah,
on that specific amount,
right.
not the
Yeah,
entire thing. Okay.
yeah.
My second question was, I thought I heard you mention not having to 1031 the entire amount
Yeah,
from the sale.
you could do a partial exchange, which is kind of similar to, well, no, it'd be the opposite. It'd be if you bought a house that was not as much money as what you sold. Um, oh no, I'm sorry, that's what we just talked about. I'm thinking
Mhm.
partial is like you're making the decision to not do all of it, right? So, right. The only thing with that is like if they don't know that they're going to do a partial exchange or not, and then 3 days after closing, they say, "Oh, never mind. I sent you 300,000, but I want to keep 100." I have to wait for those 45 days. So the money's tied up for the 45 days. And then once you identify with a value, we can cut it back. Like there's another form you fill out for that, but we do have to. So you kind of tie up the money a little bit if you don't make that decision first. But it can be done.
That's good to know. Thank you.
Yeah.
So one of the things I'm a CPA. I'm inactive right now. I'm not I know there's a sponsor that's a CPA in this group, but one of the things I always told my clients was if you don't want to pay whatever you touch, you pay taxes on.
Hmm.
And then if you don't want to pay any taxes, a general rule of thumb would be you have to buy up or equal in price and debt. So, like you're saying, is relief of debt is considered touching money. So if your new loans on your new properties aren't at least what they were on the old properties in value, then there might be a tax situation to talk to your tax accountant.
Right. Like if you're paying off, yeah, I see what you mean. Like if you're relinquishing a property with a mortgage and then buy another one, the financing should be the same because then it wouldn't be their money. Yeah.
Right.
Yeah.
Awesome. Okay. Tara Lynn, she can't get on because she's usually working. Can you delve a little bit deeper into the DE statutory trust, the Delaware statutory trust? A little bit more if you can.
So, what I do with a lot of times when we get these sort of clients, I guess, for us, it's the same, like as a QI, it's the same process, right? Like they're going to sell, the money is going to come to us. We work directly in that case on the replacement property, let's say, or fund, whatever their money's going to go. My contact is usually with their financial advisor or whoever is setting up that fund. So we won't set up the fund for them. Like for me, I have someone specifically in the financial world that has they have different opportunities every few months. It changes because if you have let's say an industrial building in Tennessee that wants 300 owners or something, or they're going to kind of build the capital that way, and once they hit the amount of ownership they need, then that opportunity goes away and there's another opportunity to get involved in a new fund, right? So they're usually the ones responsible for presenting these options to the client of like this one yields 3%, this one yields 5%, like yeah, this one has this many fees, that many fees, and they can kind of decide. For me, for my if I'm staying in my lane, like our piece is really to hold the money on their identification form. Now they're not identifying a particular property, they're going to give us those fund specifications. So whether it's the usually it comes with an address, like it has the fund, the number, the company that they're going to deal with, the address of whatever it is, whatever building it is, or I say industrial, but like it could be like a apartment building or something that's very large. Obviously they're going to take a bunch of owners for. Um, and then a lot of times those closings are even within the 45 days. We don't even make it that far because they're not shopping and we're not waiting for a closing date. It's just getting the things signed so that we can fund or send the money to this account. And in that sense, that's kind of over. But that's really I guess the what the fund will yield or whatever type of DST they're going to go into or company or things like that. Is really something that most financial, I shouldn't say most, but some financial advisors I think are more versed than others. But that's really where us as the QI are getting that information. You know, we're not placing them into one. They really have to tell us what they want and identify it the same way. And that's something I don't know if you have financial advisors on here that do that. Some do, some don't. I definitely have some of my own resources that I can share that can give them options if someone's interested in that. Um, but yeah, I don't know if that's enough information, but
Thank you for sharing. Anyone else have any questions? We have 11 minutes left. Emily, if you can state again for your title insurance company, what states do you work in? Again, it's PA, New Jersey.
Florida and New York for title insurance, right?
Awesome. And then 1031, just any state.
1031s is everywhere because they can do it in any state.
Awesome. Okay. Sade, you raised your hand. You have a question?
Oh,
Yeah,
no.
just a quick
Oh,
quick
go ahead.
question.
Go ahead.
As for the people that you've done 1031 exchanges for recently and that have purchased their new property in different areas, like outside the state, have you noticed any trends of different areas that they might be going towards?
I feel like for like trends, I'll take this off actually. Trends that they're going for, you mean like an influx one way or another? I think it's
like different cities that they are kind of moving towards?
for me in New Jersey, I think we see a lot of north to south. Like we see a lot of New York, New Jersey to Florida and Carolinas, and um, that's probably the biggest shift that I see here. Naturally, a lot of my own contacts and stuff are sort of local, so like I'm seeing a lot of New Jersey to Florida and New Jersey to PA, which is a big one. And I think it just is telling about like the increased taxes. The market is like there's just not a lot for sale, so people feel like very sort of under a lot of pressure to find something. And I think that's also why I see the uptick in the DST option because um, if they can't find something or don't want to, they're like, ah, well, I'm gonna make 4% doing nothing, so I'll just do this. Um, but yeah, for us, it's probably just north to south.
Thank you.
I can I could agree with that. I'm here in New Jersey, but I buy down south. So
Yeah,
sometimes in Pennsylvania, it just depends, if the numbers make sense, but the Jersey numbers really aren't making too much sense
yeah, it
recently.
doesn't make sense for a lot of people.
Yeah.
So
But it also depends on what your strategy is, right?
right.
Thing to do with it. So um anyone else? We have 8 minutes.
I got a question, another question,
Shoot,
Kim.
Paul.
Yeah, Emily, in regards to the Delaware Statutory Trust or the syndication, if typically if you are taking the asset that you sold and investing that chunk of money into the Delaware Statutory Trust, you get paid a interest rate on your investment, and then you also get paid when they sell that asset that they're controlling, and that's when you get paid back your
Well,
money plus profit.
you would have to sell your shares basically, or whatever percentage owner you are. They
Do they
they
tell you up, do they tell you up front not only what your interest rate's going to be that you're receiving monthly or quarterly, but also what your profit or interest would be once they sell that asset or you sell the shares?
They should, yeah. Like all of that is part of their offer, It's like their um or their option, right? Like whatever the opportunity is, they have to tell you everything, like the fees, the percentage, when it's going to come. Some are monthly, some are quarterly. Um, what happens if you sell it? I do think there's some kind of holding period, so it might be expensive to sell it within a certain amount of time versus waiting. Um, but in that sense, like the details of that stuff is really, I mean, you're going under contract with them. All those things are usually presented. So, and you do have to use somebody who's licensed to kind of broker that fund, which is why I said like why I'll usually go through the financial advisor for that. Because they're not like you can't really just I've yet to really see where there's just funds being advertised for things. It usually comes through some kind of like a financial advisor or somebody who's already into that. But absolutely, they have to disclose everything. So
So you would recommend going through a financial advisor or somebody to dig deeper and research the types of funds that are offered and type of products
yeah.
offered inside that trust.
Yeah, because they can look in different states. That's really where I feel like the conversation between you and the advisor is like what your goals are, how much you're looking to make, maybe what different things like that. So that's where I say like us as the QI, like I can't answer all of those questions, but just from the outsider kind of looking at a general perspective, like we see a lot of that movement now where I feel like it wasn't as maybe popular a few years ago. The market has like gotten not worse, but tight, and people are strategizing like all different ways. So, um, yeah, those particular questions on like the dollars and what makes sense definitely go through them.
All right, thank you.
Mhm.
Anyone else? We got a lot of gals guy on here, so we have no other questions. We have access to a great wealth of information with Emily. Okay, Chris. Hi, Chris. Hi, Chrissy. Chris threw one in the chat. Chris, you do you want me to say it or can you show your face and ask the question? Or are you working? I don't want Renee to yell at you. All right. So Christine threw in the chat. I recently did a 1031 and well, both parties were in my hometown in Western New York. I traded a single family rental for commercial property. I had the benefit of my tenant being patient to start the sale process while I looked for the property I was trading into. Okay, so that wasn't a question. That was your experience with doing a 1031. Welcome back, because I know you were in Alaska with your grandson and your son for a little bit. So yes, nice to have you back. Anyone else? We got 4 minutes. Julie got a question.
Yes, I was very intrigued by the strategy of being able to 1031 exchange into a property and then 3 years later be able to use it as a personal residence or whatever. What are some pitfalls? Is that something that's done often? And is 3 years, I mean, just anything you can share about that.
Yeah,
That's
and
fascinating.
that would be, I mean, you really, I don't want to dive too into like the tax liabilities of things because the question there is like it can be done, but I always have the question if there's some kind of like proration for amount of time it was investment versus amount of time that it's primary. I know on the opposite way it is if you sold and then if that was your selling property, not your buying one. So
Mhm.
like it can be done, but I can't really say that there's zero liability to it. There might be a proration there for that.
Okay. I have a home that, well, we live in it that I'm really not interested in living in anymore. And I would like to turn it into an income producing property. And then how long does it need to be? Did I miss that? An income producing property before I can choose to 1031 exchange it.
Right. So like that to me would be like a tax
A tax
question.
question.
Yeah.
Okay.
So
Sorry.
like,
Thank you.
I try not to like get too involved in those because the liability and the eligibility part, if you even should or shouldn't do it, I try not to, live there in that part. So, but that would be you have to ask your accountant how you can do that, or if you have to hold it for a certain amount of time, because I think you do. So.
Okay. Well, thanks again. This has been very informative. Do we have your contact information in the group?
I can certainly share it. I have
Emily, on the last slide is a QR code to your digital business card.
I
Take
just
a screenshot.
shared my screen back to put it there.
And we can always put it in the group, the Zoom group as well. And Alyssa's
Yeah.
in the Zoom group. So Alyssa can always share it too.
Yeah.
Emily, we have to get you into that group as well.
Okay. Well,
Awesome.
thank you so much for having me. This was a lot of fun. And you guys had great questions. So
Thank
love
you
that.
so much for hopping on and taking some time out to share this with us. I think it's so intriguing. I had questions, but you had answered them without even knowing it. Uh, one of
Okay.
the things I always heard was that you had to buy a like property, right? So it always held me back from really looking into it because I thought I had to buy something that was similar. But now I know I can go from,
Yeah.
one family to a, three family, or, from a regular investment property to a commercial. So I have gained valuable information here. And
And you can
Okay,
do
good.
land also.
I'm sorry,
You can do land also.
you can do land also. Yes. Who knew? Who knew?
Got options. So
Yes, good options. Thank you so much again, and I hope everyone has a wonderful rest of the week. And next week we have Miss Lisa Englehart. If you know who she is, she is awesome. If you don't know who she is, I'm on the Zoom next week. She does land development and she builds luxury tiny homes. So she's going to teach
oh,
us how to take land and split it up. And you can either keep it and build tiny homes, or you can sell partials, or you can sell the whole thing. So she'll be on next Thursday. It's going to be so much fun. She's sweet, she's funny, and she knows her stuff. She's been doing it for quite some time. So I hope you hop onto the Zoom next Thursday. And then next Friday, Friday the 13th, we have our second roundtable conversation. If you had commented that you were going to go, this one is not free. So the Zoom on Thursdays are always free. The roundtable is not. The roundtable conversation helps us keep the Zoom free. That's going to be on flipping. So we have 5 women that are coming on. We're going to talk about the good, the bad, and the horror stories of flipping. So $47 can save you thousands. So for me, it's always an investment. It's part of tuition, I feel. I've lost thousands of dollars, so I felt like if something like this was available, I would have scooped it up for $47. We only have 20 seats available, and I say that only because the women who pay for it have questions that they want answered. And if we open it up to more, then it kind of gets diluted. And I feel like everyone should be able to ask their questions and get them answered. So if you want to join us, I had put it in the chat. I'll send out another email. We are halfway full, and I'm looking forward to having Patty Bain on. We have Jasmine Elifly, who's from New Jersey. We have Brianna, who's from New Jersey, and Renee, who is from upstate New York and Orlando. She has a different take on it with the contractors because she's in a smaller town. So she pays them with beer and cigarettes. Where, us in New Jersey have to really, pay them a little bit different. But anyway, I hope you guys join us there. And if you need me, you know how to reach me, text, call, email, put it in the group. I'm here for you. If you're not in the Facebook group, please find us. It's the Thursdays Women's Zoom at noon. And yeah, thank you again, Emily, for being here.
Thank
Alyssa,
you.
thank you.
Thank you, Kim.
Dale Maker Central Jersey, we're revamping it, so you'll get what that's going to look like moving forward. All right, everyone, have a great day.
All right,
Talk to
bye.
you.
Thank
Bye,
you.
ladies
Bye-bye.
and gentlemen.
And gentlemen. Yes, goodbye.
Gentlemen.
Yes, gentlemen. Bye-bye.
Bye.